You know, there's a big differential between supply and demand going on with crude oil around the globe today. There's something that most of you are not really aware of or paying attention to, and that's what I call soft barrels of supply. What's a soft barrel? A soft barrel means that the differential between the wellhead production and the final consumption is probably only about 60 days apart. So, in between the actual wellhead production and the actual consumption of that barrel by the consumer is a soft barrel that exists. And that soft barrel is what we call excess supply. That excess supply exists in multiple different resources. One, it can be from the tanks that are physically holding oil at the wellhead location. It can be at collection or disposition centers where fields are depositing oil at larger tanks or holding facilities. It can be in salt domes and other traditional storage facilities for crude oil. It can be in pipelines. It can be at oil terminals. It can be at refineries, or it can be on waterborne vessels. So in between the wellhead production and the actual consumer taking that barrel and using it and disposing of it forever, never to be on planet Earth again, we have soft barrels. Now, why this is important is because during this last 75 days of conflict in the Iranian war, we've been looking at prices of oil hovering around $95 to $115 a barrel. And everyone has convinced himself that it's going to stay at that level or go much lower back down to $70, $75 a barrel. But in my opinion, with 41 years of experience in the oil and gas industry and watching global markets for over 4 decades, I believe all that's happened the last 75 days is every producer out there has dumped and used and has put into the marketplace soft barrels. They took 1.5 to 2 billion barrels of oil that were in storage facilities, pipelines, terminals, fuel tanks, etc., waterborne vessels, and they moved that into the market with hopes that they could satisfy the normal demand day-to-day of crude oil around the globe. Hypothetically, if we're making 101 million barrels of oil a day and we're consuming 101 million barrels of oil a day, we're kind of at a static point. Supply and demand are equal. What we've seen is a disparity because of the global disruption due to the Iranian war and the shutting down of the Strait of Hormuz. We've seen 12 to 13, 14 million barrels a day that has been absent in the normal supply. So call that a 11 to 12% decrease in available supply based on normal demand. Only 2 ways to satisfy that. Lower demand, which is slowly happening in a very small scale, or add additional supply temporarily into the market to appease that supply-demand curve. These soft barrels have already been used. So as I've been saying since this war broke out, if they, being those that are the powers to be, do not resolve the flow of oil coming out of the Middle East and open up the Strait of Hormuz, we're going to only have so many soft barrels we can put in the market. Those soft barrels, in my opinion, are done. We might have an extra 100 to 300 million barrels of oil that are still being put into the marketplace from G7 or the U.S. Strategic Petroleum Reserves, but that is going to be very quickly absorbed into the marketplace. I think starting in the month of latter part of May, first part of June, throughout the summer, the markets are really going to see this absence of soft barrels of oil. And if that strait is not opened up immediately or in the very near future, you're going to see a resolving price for crude oil. It's going to be much, much higher than anyone has predicted because you're going to have buyers and refineries and countries and consumers that have to have that crude oil. They have to have it in every form and fashion for all the products, transportation, for byproducts, synthetics, fertilizer. They have to have it. So they're going to compete for that oil. To be less oil, same demand, even if you reduce demand, it's still going to be way short in terms of supply. Soft barrels is what no one's talking about. We have artificially filled soft barrels into the marketplace, and that's the only reason why today you're sitting at about $105 a barrel. It would normally be $125 to $150 a barrel like it was during the war when Russia started it with Ukraine. Today, we artificially have held back what's going to be a cataclysmic rise in the price of oil if we don't open up the Strait of Hormuz. Today, soft barrels have been used. There is very few soft barrels left. Now you're going to be mark to market, wellhead to consumer, and you're going to be missing 10 to 15 million barrels a day. You're going to see $25 to $50 price hikes in oil between now and the end of June, most likely.